Good morning, traders and investors. Todd Gordon with tradinganalysis.com, soon to be Inside Edge Capital. And hope you guys are doing well. Happy Wednesday. And we just got some interesting CPI data that I just can't help but laugh. So let's see, just before we jump into that and talk about that, we have futures up pretty good here. NASDAQ up 0.5, Dow up 0.5, the RUT 0.7, so a little small cap leadership. Crude oil up 1, bonds down just a touch. Looking okay there on the open. So it looks like CPI, of course, this is, this might be a time where inflation is becoming more important. Obviously, with all the fiscal stimulus that the federal government has put in on top of the decade-long monetary stimulus with the with QE programs and pinning rates to zero. So the CPI level and core were well within reason, certainly nowhere above the 2% level that is concerning everyone and causing this big move down in bond prices, up in yields, down in NASDAQ, up in financials, up in, dare I say, commodities and crude oil. And God, it's funny. I had 2 text messages. I just reminded myself, 2 text messages from 2 separate buddies who are in commodity related industries. They're like, "Hey Todd, how much more are these commodities going to go up?" One buddy makes batteries for watches, and he's like, "Todd, the price of silver is doubled. What do I do?" And my other buddy, I'll tell you him, he's the one I own the whiskey distillery with. His first business before starting the distillery with me was scrap metal. And it's been down for a long time. And Ryan, Ryan, I'm free to talk about him. You've probably, if you ever watched any of my YouTube videos, he's like, "Oh my God, scrap metal's going crazy, blah, blah, blah." So yeah, it's all related. It's interesting. All right, so let's talk about that. CPI was certainly well within reason. Futures are coming back. Looks like we have a pretty good bid coming back off the market. I'm going to leave that heavy lifting to Bennett for now. But I love this chart of the 30-year bond, and this is just the kind of one of the classic things whenever I'm giving a speech. I did this at the Money Show in New York when I was one of the keynotes. I did it in Vegas when I was keynote. This is in front of a room of 1,000 or 1,500 people. If you say, look, if you're at a cocktail party or at the roulette table after the speech here in Vegas, and you guys are all talking about investing, throw this out there and just see what people say. If like, well, what's your traditional relationship between bonds and stocks? And guys, while you're here, type that in for me. What is the traditional relationship between stocks and bonds? In the YouTube window, let me know what you think it is, and let me pull that up. And this always cracks me up here. And so what I'm doing here, this is the 30-year bond, not the yield, the price of the bond since 1980. Okay. And I think you can see where I'm going here. If you just overlay the S&P on top of this, I think you know where I'm going with this. Make it in green. It's up. So bonds have been rallying with stocks since 1982. All right. So you're talking 12 plus 21. How about 34? Hey, Fibonacci, 34 years that we've been, 22. 43 years. Longer that I've been alive have stocks and bonds been going in the same direction. So my point here is like, okay, why are people all of a sudden starting to get upset that yields are moving up and bonds are selling off? We go through this little fits and starts with this, but this is a normal, healthy relationship. Now, if you want to push back and say, well, rates are getting to the point, they did get down to the point where we're going zero, as the 10-year yield got below 0.5. Okay, that's a new experiment in capital markets that the United States has not dealt with, overseas has. And there's been a lot more talk about it. So we're kind of at that zero boundary. That's concerning. But they've been going up since we've been alive. So I've been trying to, put some content out there. I've had a huge swing down in my account. I'm very tech heavy. I did a YouTube video last week talking about the return in my 401k. I'll show you that. But I need to get a little less heavy in tech. But the point of all this is I don't see a big reason to really divest from technology. Let me do this. Let me take the 10-2 spread. Okay, yield curve is very important. So look, rather than just looking at the yield on the 30-year bond, let's look at the 10-2 spread on top of the S&P. Let me go normalized percent change. Okay, let me go down over the last, let's say, 10 years. And let's just see what we can kind of detect here. This part is a little concerning, where we've seen the normalized change in the 10-2, the percent change in the 10-2 drop. But all of a sudden, we're starting to see it move up here a little bit of a cause for concern. But if we look back here in 2012, we've seen that as well. We saw stocks actually begin their bull market in 2012 and actually not begin, but continue the rally from 2008. So let me go back here. Let's go back to the turn of the century. It doesn't want to give it to me. That's fine. 5. Okay, that's a little better. So this is the purple is again 10-2. This is the credit crisis. We saw a pretty good steepening of the yield curve, which is interesting here. Okay, and then we saw a pretty significant decline right here as stocks have rallied. Normally we do want a steep 10-2 curve because that's the shape of a healthy economy. I'd want to do a percent change relationship from 2012 to 14 and see where we are there to see if we might start to resume lower on the downside. So, I'm not seeing too much that from a yield curve perspective. And again, with the benign inflation data that we have, is that much of an issue? All right. So as I said, I did a YouTube video last week on the return of my 401k, and this is a little bit of a marketing piece. I admit I feel so dirty doing those videos. Say, oh, I made this much money, like so cheesy. But it was a really good year in my 401k. And this is the same account that I've been showing you guys forever. And the reason I brought it up is, it was up 82% with very heavy tech exposure. But if you go and look at kind of the performance over the last 3 months in the beginning, and I'll even just show you the what's happening here, the performance is starting to drop here a little bit. And it's because it's so heavily in technology. And, if you look at the 2 portfolios that I'm running for money management, you look at value and you go into performance right here. So the value portfolio that I hold is in purple year to date compared to the S&P. So we're up, this one's up 6.9, S&P up 3, and then NASDAQ down 0.5. So my point of all this is, time to get other exposure. And that's what I will be doing. I will divest from technology a little bit. I will start to bring in some other sectors that have been very long technology, buy and hold, not trading, buy and hold. And that's what allowed me to be up 82%. I did put the NDX hedge on. So the butterfly was really good. I drew down for my overall portfolio over 6 figures for me, and that's fine. I'm okay with it. We did manage to get about 35,000. I got about 33,000 back on the butterfly. So we did a little bit of index hedging. I have another one on here, which is going to be a loss of 6,500. So that's fine. I am hedging. So I do think, we're in a bullish situation here, but I do think other stocks, other sectors and industries will participate. Did CNBC yesterday, had a funny conversation with Terry on Tesla. We'll talk about that. For some reason, guys, I'm going to bring in the team here. I got a lot going on right now. As you get older, over 40, getting this thing, when you're waking up at night, and could be part of launching a business. And are you laughing in the background, Terry?
I'm laughing, yeah, because you're using 40 as the marker.
I mean, I don't know. Do
you
like,
probably feel like me right now, though. If you only got a few hours of sleep.
Terry was up at 4:30. I mean, do you remember? Not to go off topic, but isn't it generally around 40 where you start not sleeping through the night?
You don't need as much sleep, I guess.
I mean, and yesterday I did a Peloton ride. I mean, I crushed it. I got outside right after CNBC yesterday. I took the kids. I did a live Twitter because I got the new iPhone, the new 12, and all of a sudden I popped up. I was like, oh, cool, I got 5G. So I did a live Twitter. I had all like 9 neighborhood kids. We're all playing out in the stream in the back, and they're chasing snakes because they're coming out of hibernation. That was kind of fun. So I had a full, really hard Peloton ride. I got fresh air. For some reason, I woke up at like 1:30. So I started listening, and I just go up for 2 hours and just try to do something productive. I was listening to an old Kathy Wood interview with Elon Musk back in like 2019, and like it only had like 400,000 views on this video I was watching. I was like, that's crazy. But so we were talking about Tesla yesterday, and I'm gonna pull it together. I don't want to go off on this quickly. Do you want to show them their chart, Terry, or do you want to wait later on, Bennett? You guys tell me how you
we'll share later, but I'll just say that I had no idea that Todd, honest to God, I had no idea Todd was going to talk Tesla on CNBC yesterday while I was making my notes up for today's show. I happen to have almost the same chart that he did. I borrowed a little bit after I saw his show. We'll leave the rest here for my segment, but I thought it was hilarious because I mean, I turned around to watch Todd on the TV, and I'm like, I look back at my screen and I've got the same thing. So great minds think alike, Todd.
And they say technical analysis is subjective. But I can't keep. I'm quickly becoming a Kathy Wood fanboy. Am I late to the game? Yes. Her outlook on Tesla, I love. The company, I've been bullish on Tesla for years. But I'm really starting to have a man crush. I think I'm gonna be honest with you. I really like what this company's doing, and I just love the valuations that traditional fundamental analysts can't understand and explain. And I've been trying to knock on that. I've been reading about Tesla and looking at what they're trying to do, and looking at this autonomous driving, and looking at the billions of miles of driven miles they've collected, and what first mover advantage really means. What he's doing with SpaceX, which I love. I'm partially a space shot. I'm self-admitted. I love looking at and getting the kids into looking at the stars and what's going on. But what he's doing, I just, and then reading the headlines and saying, oh my God, Kathy being taken to the woodshed for sure. ARK is getting crushed and Tesla's the biggest holding. Oh my God. It's up 39% this year. It's up 1,700% in a year and a half. Give me a freaking break. Come on. It's like, it's just, there's so much noise out there. I'm like, look, I do want to get more non-tech exposure, but at the same time, the exposure that I will hold for my clients in my business trade analysis and my personal money, I will have less tech exposure than I did last year to make 80% return in my 401k. But the lesser percent that I do have will be more highly convicted, if that makes any sense at all. Bennett, if you guys have anything, jump in. If not, Bennett, show us what's going on in the markets.
Yeah, no, I was just going to say you had a good comparison when you were talking about Jeff Bezos and Amazon originally starting out as an online bookstore, and just look where that company's come.
Right, and they're jumping into the autonomous driving and AWS, and oh my God, it's amazing what technology is doing. And I don't want to be a tech fanboy, but it's really, really hard to not see that we're the next. It's hard to what?
It's hard to let go of something that's moving. I mean, the market's going to take its ups and downs. But yeah. I'm with you, Tom. I'm not wholesale abandoning tech. There's no reason to. So that's like I said, we'll monitor. We'll get in and out of good trades, but you can't just blindly invest in tech. I think going forward, you do need to do your filters, and you do need to use sector rotation tools, other technical analysis, and fundamentals, and And, you know, I mean, 20 years ago, technology stocks didn't have fundamentals, right? They were just riding high on, hey, I want that. Now they actually have fundamentals to play with. So, yeah, so
Right.
we can use all the tools available to filter things.
Exactly. And Kathy makes the point, which I really like. She's like, I don't want to see profits now. I want to see exorbitant PE ratios and massive forward earnings. She's like, I want the company taking on debt and investing in themselves, profits for down the line. I can tell you my 3 kids, their 529 plans. I'll tell you what I hold in them: XLK and ARKK.
Yep.
That's it. You know, I mean, they're not going to need the money for 15 years. I mean, even that's a little bit of a short horizon. I feel a little bit better with Eden, my 2-year-old, who won't need the money for 18 years. But that's all I'm holding is ARKK and XLK. And as we get, you know, more, I'm building that account up for the kids. They'll be more diversified, but for now, that's all I want. So anyway.
All right, let's jump into it. A little hard right edge and see what's going on in the markets. Good morning once again, YouTube. Thank you guys for tuning in. Hope you're doing well this morning. Do apologize for getting started a little bit late. Let's jump into the MotiveWave platform, taking a look at the hard right edge of the chart. So if you guys have been following our work, or if you follow me on Twitter, you'll know that coming out of, let's see, what was this? The January 29th low. We noted the fact that the move lower unfolded as a 3-wave measured move. So we came out on the 2nd of February and said, look, likely going to see the market move up into 38.90 to 39.20 area fib resistance, which also happened to line up with an Elliott wave channeling technique that we use when trying to determine 4th wave support and 5th wave tops. And we were anticipating a move up into that zone, at which point we did expect a corrective pullback. The actual intraday high that we printed was 39.50, and we've since seen here in the S&P about a 5.7% correction peak to trough. We are now faced with 2 very distinct possibilities in terms of where we go from here. And I have absolutely no problem saying that I don't know what the future holds. I'm smart enough to realize that, which is why Elliott Wave is all about possibilities. So I see 2 very distinct possibilities. The first one is the count that you see here in front of you, which basically assigns the September through October correction that we saw in the indexes as the wave 2 correction of the higher degree. And the move that we've seen since the October 30th low is in fact a 5-wave completion. This 5-wave completion gave us a corrective pullback that is larger than anything we've seen since the October 30th lows. So from an Elliott wave point of view, in terms of the fractal nature of Elliott, this is very appropriate to see and actually look and count this as a completed 3-wave structure. So all we have evidence of here is a 3-wave move to the downside, and we have seen a fairly significant bounce back. The damage done in tech and the NASDAQ is a little bit more significant. I think that will chop and slop a little longer attempting to come out of that zone. But I want to give you a couple actionable takeaways. So what we're going to do here is we're going to dive into essentially everything that's happened here in the S&P since the February 16th high. We shorted the markets back here on Feb 8, covered yesterday, and now we are actually covered a few days ago, and we're now just kind of awaiting a more clear path. The great thing about Elliott is I do feel that this is going to resolve significantly, whether it's to the upside or downside, and we'll have a fairly well-defined area to trade into. So what we're going to do is we're going to get off the 195-minute half-day chart. And for those of you interested, I got a few messages asking why I use the 195-minute chart as opposed to the 240-minute time frame. 195-minute is exactly a half-day trading session. So you get 2 candles to make up a full day's worth of trading action. So we're going to take you down to a 20-minute chart, and we have both interpretations labeled here for you. I have the ABC pullback, which suggests that the wave 2 correction is over and we are getting ready to resolve higher. And as you can see here, we have labeled a 5-wave move. So off of the March 4th low, we have a motive impulsive 5-wave advance. Now this could still be 1 and 2 inside of this blue 5, and we move up into 3900, 3916, 3917 again. But I do anticipate the initial directional wave that we are seeing here to resolve in some sort of a corrective pullback. And that, I feel, is where the more confirmed entry opportunity lies from a trading perspective. So I'll be looking for any resemblance of a 3-wave pullback to follow this 5-wave advance. And alternatively, we just did a massive leading, expanding variety diagonal here in 1. This is a 3-wave flat, kind of a tricky flat, but it is acceptable. You have 1, 2, 3, 4, 5, 6, 7 major swings lower here. We did not violate the 1618 external retracement of the B versus A. And now we have a 5-wave move here in C that can be explained as a 3-wave flat. We're into the 78.6% retracement. This is a very unlikely count in the S&P, just simply based on the guideline of the right look. But the reason I'm still tracking this as a possibility, because remember, Elliot's about possibilities, and we await for confirmation before establishing trades. The reason I'm still tracking that as a possibility is simply due to the damage done that we've seen in tech. Yields on the move, the dynamic at play in the dollar. If you guys follow my work and Alex's work on the YouTube channel, you'll know what we've been watching there. So taking a look at the NASDAQ, you can see that the correction that we saw off of the high was about 12%, just over 12% for the NASDAQ, where in the S&P it was about 5.7 as we just looked at. Here we have a nice ABC measured move bounce. So all we have evidence of is a 3-wave decline. Taking you to the alternate interpretation, you'll notice we're still trading below 12,850 to 12,900 resistance. So I want to see 2 things happen here. I want to see the NASDAQ move north of this resistance zone, and I want to see the S&P retrace the initial 5-wave print, and that's where I'm going to be personally looking to start reestablishing long trades in the market. Just to give you a quick educational takeaway for why you should always, just kind of a PSA, if you would, on always being conservative when working your Elliott wave count. So here's Virgin Galactic, ticker symbol SPCE. And what we're doing here is we're going back to 2019, December of 19. We can count a motive impulsive 5-wave rally. We then enter a 1, 2, 3, 4, 5-point sideways consolidation. This is an Elliott wave triangle, contracting triangle. And when the triangle came to completion, we print this 5-wave move to the upside. From there, we were looking for a 61.8% retracement. We were also looking for the kind of expanded trend line from the contracting channel to also give you your support line. So as you can see, 5 up, 3 down into the 618. And from there, Virgin Galactic moves from $22 a share all the way as high as $62 a share. And logically, looking at this structure, one would be inclined to say, oh, this is a directional motive wave in A. This is a B wave triangulation consolidation. We should anticipate a motive wave to take place in this C wave upside move. Notice we actually printed a 3-wave move. We could no longer look at this as 1, 2, 3, and 4 due to the overlap that we're seeing. So this goes to the point that when you have an initial directional wave, this is an actionary motive wave, and you have a secondary counter trend move, you should always be conservative and look for initially a secondary directional wave to follow. Automatically saying that that is a 3rd wave can certainly get you in trouble. And that usually happens with new issues such as Virgin Galactic, okay? Another really awesome point that I want to make a note here on this chart is you'll notice that the rally from December of 19 through the highs in Feb of 20, a 78.6% retracement of this decline was resistance here in the A wave. And you'll notice, Todd teaches this in one of his courses, a break through the 78.6% retracement often opens the door to the external 1272 retracement. That is pretty much spot on where Virgin Galactic ran into resistance. Okay, so that's it for me today, guys. I'm open to trade either count here in the indexes. I would await a retracement of this initial move. Let's see what today's session brings. And that's it for me. Back over to you, Todd.
That's awesome. Thanks, Bennett. Good work on SPCE, and then with the indexes, they're tricky for sure. I've been trying to push or coax the team, and these are my friends, these are my coworkers, And I respect their work, but I've been trying to get them to be more bullish, because I've been bullish, and as my opening comments, like I think rates are going to be capped. I don't think the 210 spread is any indication that tech is going to sell off. So I've been trying to get them to be more bullish. They're not wrong at all. I think Bennett is possibly a little bit more maybe distrusting of this, and he may wind up being right. I know he's looking at both ends of sorry, the camera's moving. Both ends of the of the move in the index. So can't wait to see where that goes. The other thing is I'm going to turn it over to Terry. One thing I did want to talk about on the other side after Terry does the sector work is Peloton, which, you know, he mentioned new issues. It's hard to figure out where to start the wave count. Peloton, you know, and all companies that were within a couple of years old, you know, where do you start the wave count? And I would like to kind of challenge you in a discussion and see what you think. You know, I would argue on Peloton, you know, there's a move up in 1, down in 2. Where do you put the beginning of 1? Well, it's got to be at 0. At some point, the company started on the private market at 0. So I think when you have new issues, and that's the challenge with all these new age tech companies coming on, is how do you do an Elliott wave count with a company with not very much history? And I think the answer is at 0. And on the other side of that, I'll show you Peloton, and I'll show you why I think this is a good reentry. But sector rotation is the lifeblood of this market, and that's all very much been pushed forward from interest rates. And that's why Terry's going to take us through the sector spin and get us straight as to what sector is showing strength and weakness.
Hello, traders. I'm Terry Long with your weekly sector focus. Start with last week's performance of the index and sectors. And as Bennett showed us, after a roller coaster ride last week, S&P actually closed up with a 0.81% gain. The NASDAQ had a little bit more steeper decline, down 1.87, but a big snapback there on Friday. And then you can see in here Monday and Tuesday's price action. S&P is up 0.87, NASDAQ's up 0.99 there. Last week, the energy sector soared, nearly 10% gain on the week. The financials, industrials, communications, materials, utilities, and staples sectors outperformed the benchmark S&P, while healthcare and technology, real estate, and consumer discretionary were the week's underperformers. Now, once again, though, markets are seeing wild gyrations. Monday saw the NASDAQ continue down in its decline. You can see this large candle here. Tuesday saw a sharp snapback for tech and discretionary, but ultimately both were up nearly 4% on the day yesterday. Now, as Bennett probably mentioned, we only have 3 waves here to the upside in the S&P, but we'll leave that for his wave counts. Let's move on here to this week. This is Monday and Tuesday's price action. You can see the leading sector this week now with this huge recovery play is the consumer discretionary, followed by utilities, materials, and real estate. Now, these utilities and real estate are lagging sectors, but they're making some accelerated moves here. Materials is picking up some momentum here. Energy given back not nearly 10% like it gained so far, but down about 1.5% on the week. Here's the weekly sector RRG. This week, our leading sectors are energy, financials, communications, materials, and technology. What the heck? Okay, guess I got to reboot my computer later on. Note that the industrial sector is now one of the underperforming sectors here. But it has formed a clear hook back to the north, indicating that momentum is returning to many stocks in that sector. Now, both energy and financials continue to gain relative strength. You can see this nice push to the right here. Moving further right you go, the higher the relative strength against the benchmark. The communications sector also is pushing up into the leading quadrant. Now, a couple of weeks ago, I'll bring this back and animate, we had technology up in the leading quadrant, but it rapidly reversed on us here. You can see that reversed heading, and is pushing back down into this weakening quadrant on a similar vector as consumer discretionary, with no clear sign as yet of any reversal until we saw Monday and Tuesday's price action. So we'll see how the rest of this week plays out. If we get a continuation, certainly discretionary is moving as we speak. So this week's focus is going to be on the consumer discretionary sector. And let me go back here. I got another note. I'm just scrolling through my notes here. I want to talk a little bit about this materials before I jump right into the consumer discretionary. So materials is kind of wishy-washy here, not really doing much, some sort of short-tailed zigzag movement. This indicates hesitation, a little bit of further relative strength decline, now possibly the formation of a new hook north in momentum. So if I bring in Monday and Tuesday's price action, this very last jump here in this animation you can see is the results of the Monday and Tuesdays. Now we've got both industrials and materials shooting back up to the north, reestablishing momentum. Means investors are pumping money back into stocks in this group. All right. Now, last week, the consumer discretionary sector was the worst performing sector, falling 2.7% on the week. Now, the two largest market cap stocks in this sector is Amazon and Tesla. And both of these have declined sharply down into possible support levels. I want to bring this chart up. I swear to God, as Todd was doing his CNBC thing yesterday, I was making my notes on Tesla, and he brought up this long-term chart. I will say that I did borrow his percent declines, but Todd brought this long-term chart. I had already drawn this parallel trend channel and was already scoping this out, and I flipped around and Todd was talking about it. So that's the funny little story there. But yeah, this is the COVID decline, right? So markets rolled over dramatically here. Look at the change in the slope. I've taken this same slope and projected it up here, and you could move it to wherever you think the top in Tesla has been so far. The decline that we're seeing now is nowhere near the slope of the COVID decline. It's a little bit more shallow, so it's a much more normal decline. We've seen a 39% drop from the top, but if this lower trend line here is the downtrend channel support, there's more to go. Not saying that we don't see some more sideways price action, but possibly you could see more consolidation here in Tesla. Amazon, let's pull Amazon up because I've been keeping my eye. So Amazon actually looking like a little bit more like it's rolling over. It's been in this long sideways consolidation here and just doesn't want to seem to get out of it. So we had this as a triangle, and I told you earlier I had A, B, C, D, and I had E possibly, and I told you that if we broke below this level here, that we would invalidate the triangle. I've since converted it to a flat, a running flat here. And it looks like we've found support here before going below the A wave with this sharp tick down. Look at the candle here, right? Look at the body of this candle is very tight, and the intraday motion swept down, took out the stops, and pulled it right back up. And now we've got Amazon back on an uptrend. So I'm going to be cautiously optimistic and say that we have the makings potentially of a new uptrend. As yet to be confirmed, this could certainly roll right back over. There's no guarantee, and it's always difficult to pull or forecast the end of fourth waves. But I'm going to keep my eye tight here on Amazon. Let's take another look here. I want to point out Chipotle. Chipotle has moved below its support levels and is reaching down towards its 200-day. So this, I had this prior resistance that we broke through. This became support, and now that support has been broken. We pushed down to the 200-day, snapped back off of that 200-day, and now we're sitting back up here at this 1426 resistance level again. Yesterday Chipotle made a big recovery play, you can see, but we paused right here at this support level. Possibly we could see further consolidation in Chipotle, or possibly we could see a move higher. I think it's too early to tell. And if we put the wave count, Bennett's does his magic, we'll put that on Chipotle and take a little bit closer look there. Now, one of the nice stocks I'm seeing in here is automakers Ford and GM. If you look generally, you see most of these vectors are pointing down to the southwest. But look what's going on here in both Ford and General Motors. Both of these are bucking the trend. Both of them have rising momentum and rising relative strength. And I believe both of them are doing quite well, pushing higher here in the market. So let's look at Ford real quick and pull that up. Here is Ford. And so I've got it in somewhat of a parallel trend channel. I've got some overhead resistance running right here. This is a historical high around 13. And we're running a nice, just a nice channel holding solid against that 21-day moving average there. All right, let me get back to, I want to move over here to this consumer discretionary industry list. This, the consumer discretionary sector is divided into many industry subgroups. And this is the RRG chart showing you all of those particular things. I think this graphic is easier to understand than looking at a table here. And why are Ford and GM outperforming? Well, they're over here in this automobiles group, right? So this list here is sorted by relative strength ratio, and you can see the automobiles index, travel and tourism, auto parts, recreational services, and gambling index, etc. These are the strongest ones, but we're going to look at which ones are moving higher. The automobiles index has enjoyed a significant run with its relative strength ratio way out in front, but the downtrending vector tells us that the momentum has been waning in this group for now. So this is the automobile group. You can see it kind of looks like Tesla, probably because Tesla has a big influence on it. And okay, so but in general, this group has been seeing some consolidation. Let's I want to take you into the list of automotive manufacturers and show you that it's not just a fluke. It's not just Tesla. And sorry, where did it go? There we go. Let's get our scales back here. I hate when this happens. Lock price ratio. Turn that little guy off. There we go. So yeah, this is that Tesla chart again. But this is a list of automakers, right? Here's NIO, and let's just flip through these real quick here. Here's NIO. And I've got somewhat of a wave count here. I do think we're going to consolidate. We've got another push higher coming, but I think we've got a consolidation. NIO is coming down into this 200-day moving average. We'll skip over Tesla. We already talked Tesla. Here is another one. I had all this set up, and that I got to figure out how to turn that off permanently. There is NIO. Here's General Motors. Here's Ford. Yeah. You know, live TV, something always goes wrong whenever you're trying to make a demonstration here. Let's pull this RRG up here because I want to show you real quick all of these various automakers and look at the rotation that you're seeing here. Right. NEO, XPEV, Lee, LMPX, Tesla. I believe all of these are electric auto manufacturers. They're all moving into the Southwest. They're all losing relative strength. They're all taking a bit of a pause. And you only really have Ford and GM and maybe this NIU, which is a very new stock, I believe. It's also a Chinese automobile manufacturer, electronic automobile manufacturer. It's got a pretty choppy wave count there, but and possibly it's finding support again and moving higher. So unfortunately, there's not enough time to go through all the different groups here in the consumer discretionary list. I'm going to leave that exercise to you, but I just want to let you know I'm always on the lookout for stocks that exhibit strength in the face of market volatility and uncertainty, because those are the ones that are likely to become the best outperforming market when the uptrend continues. So here's to another exciting week of trading. Back to you, Todd.
Thanks, Terry. Great work. Market just opened, and let me just give you a quick run through here. Looks like on the open here, NASDAQ leading the way, up 1.16, S&P 0.7. Dow's up 0.7 as well. So, okay, not bad. Pretty good bid there right after. And I was kind of reading some at the same time. Some Zero Hedge always makes for some interesting read, talking about the CPI print being completely manufactured. I mean, they're always they're always looking for, the hole in the story, sort of the anti-establishment view, but a pretty good pump there on a CPI, which it is what it is. A couple stocks I just wanted to look at quickly. Peloton, we talked about this one on air. I've been a Peloton bull for a long time, and this is something that I would challenge you guys. Elliott Wave is really meant to track human progress, human interaction, our productive capacity, which is measured through economic output, which the best indicator of economic output is your stock market. So it's hard to take, Elliott Wave and put it on something like foreign exchange, which is, which, as Drew Baptiste taught me, he was my Elliott Wave mentor, is central banks' mismanagement of their currencies, which is a relative back and forth game. And crypto, a little bit more, what Elliott Wave stands for. And then stocks that just started, with a relatively short period of time. Where do you start the Elliott Wave count? I think you'd have to start it at zero, right? A company that just came online started from somewhere. So I think you put it at zero. Let me know what you guys think on that. But, we had a pretty good move up here in one in Peloton, down in two. I think this is very clearly a wave three that breaks down into a nice 5-wave motive move. So we've got 1, 2, 1, 2, 3, 4, 3, 4, big three. And now all of a sudden we're coming down here in 4, testing the area of the prior fourth. That is similar to this initial decline that we saw back in into the COVID lows. And again, where did Peloton start? Probably somewhere down there. So you'd need to know the percent change distance in one, considering that wave three is an extended wave, to project how far wave 5 would go. And where I have wave 5 and wave 1 now, I mean, it's significantly higher here in Peloton. So I like the pullback. I love the offering. I think Peloton is succeeded leveraging their social network. Their incremental, membership turnover is amazing. They lose less than 2% a month. They're diversifying outside of just cycling. And we're joking about being over 40. I'm going to have knee surgery coming up here soon, but I can still get on the bike. And when those joints start to get sore and you start to feel your age, cycling is a great way to exercise. And, I like the road bike, but I don't want to go get killed on a car because someone's texting. So I really like Peloton on the pullback here. I hold it and I have enough, so I'm not going to do too much with it. Tesla is another one that Terry mentioned, and I'm going to bring in Alex here real quick. Tesla, this guy started, I'm pretty sure we can call this wave 1. Big sharp decline here in COVID lows. This is what Terry was talking about. This was a 63% decline in wave 2, which is very common. A very sharp decline is common. Usually a 61.8% relationship is what you expect in wave 2, and we got to 63, so that's fine. Big old huge move up here in wave 3, and then as much as from a fundamental point of view and a visionary point of view, and a disruptive point of view, love Tesla, it really does argue it's 5 waves down. So I did talk about support down into the 550 area here on CNBC. We're now above 700. Just be careful the B wave move up. 61% it's at 740, 786 is 806. We're obviously through the 50% at 696. So your resistance zone is up to 806. If you start to fail, then we might have that C wave ride down into 500. And if you do a 4v2 time analysis, that's much more in line. Wave 2 is directional zigzag, where wave 4 is kind of sideways and meandering, going out to 161 to 200% time relationship of 4v2. So like it in Tesla, just watch that zone right there. And then another one that I did in that YouTube video where I put the NDX butterfly hedge on. Again, that was a really good, that was a perfect pin. That was one of the better ones, risking $5,000. I made 30 grand because we did at Trade Analysis see some tech weakness coming. I also took half profits in Roku. I've had this guy since back here in the early stages of wave 3. I rode him all the way up, and I took him into the 400 area right here. Same thing. Really nice chart here in Roku. 1, 2, big old wave 3, ABC down in 4. It might not be all of 4, but we should be able to get a pretty good bounce back into the northern part of the 400s there in Roku. If not, it's going to just take us up to new highs if that's all of wave 4. So bullish on Roku. Okay, let's get a quick update. This is a long show, I know. Let's get Alex in. And Alex, why don't we just go into crypto, if that's okay? We want to get these guys out of here. If you have something to say on macro, do a real quick. You save the best stuff for your show tomorrow at 9 o'clock. Your own show, your own live stream where you're crushing it. Be sure to check it out. Just get them out of here quick, Alex, okay? Sorry for just a short amount of time.
Yeah, sure. Just to take a screen. Can you just pass me a screen?
It's coming your way.
Yeah, thanks. Just real quick, I will show you the cryptos quickly. I just wanted to reiterate for a second on your beginning remarks about the ARC. So this is the ETF Innovation ARC, which has a really, really nice bullish pattern. So I'm just gonna kind of invite you to check that, which is a technology, millennials, all of what we are talking about for the technology age that we are coming in. So I would like, maybe Todd, you probably already checked it, but I think it's a very nice developing pattern on the upside. So let's go and check Bitcoin. Bitcoin for now, it's in a kind of a sideways pattern. We are still looking for some type of a triangle. 100% time elapsed in a wave 2, previous wave 2 and a wave 4 is still not there. So I guess we're gonna have a little bit more sideways before we start moving up potentially to this 72, 76,000 target. On the higher time frame, cryptos are still bullish. Let me just align this chart with our outlook. So this is still very, very ongoing, very nice bullish uptrend, and we are going to stay bullish on the cryptos, just trying to get on a swing trading this 3434. But overall, all cryptos, Ethereum, Litecoin has a similar wave count, bullish wave count. So if you want to check it up, join me tomorrow for a crypto lab, and you can kind of see what we are looking for the rest of the crypto space. So back to you, Todd.
All right. Hey, thanks for that quick update. Alex, where's that 786 retracement in Bitcoin? At what point will you abandon that ABC? That ABC up?
I didn't quite catch that. What do you mean about the Bitcoin in the sense of a triangle, or?
No, just so you're looking at ABC up in Bitcoin, right? And
I'm looking for a yeah, it's above 56,705. We are trading above 56,196. So equality between A, B, and C is a little bit above 56.70. So
got it.
57, it will be, yeah.
Okay, so what usually the rule that we use, right? If the retracement exceeds a 78.6% retracement of the prior motive or corrective wave, then you're looking for extension up, right? So where's the 786 of B and A?
Okay. 786 is around.
Right.
I will tell you exactly now. It's at 54,550.
Okay.
So it's a little bit above. Yeah.
Could we reach to the square root of 1.618, which is 1.272?
I mean, a B wave in a triangle can go above the previous highs of the A wave, close to 127. I would like to see what the equality will do, and then I will look for 127. I still cannot be bullish because the pattern is still not developing in so bullish sense, and time measurement is not agreeing, but I'm definitely going to look that. I don't think we're going to go directional, but I'm ready for it. So I'm just looking the markings. So equality is now 127 is around 62, and we already passed 786. If you're asking me that,
Alex, I was up at my parents' house last week, and my dad's had Bitcoin, and based on your recommendation, we sold half the Bitcoin. So if it breaks the new high, no, I'm totally kidding, but it was such a cool. It's such a cool experience. He's on Coinbase. He hasn't logged in 2 years. It's like, Todd, I don't know how the hell to get in here. What do I do? I went up to his, and it was just amazing. It was just, so I sold half of his Bitcoin, took the money, wired it because he didn't have a PayPal account set up. So I was like, okay.
Yeah.
So I wired it from Coinbase. I just transferred it from Coinbase to my PayPal account. And then he realizes, I hope he doesn't listen to this. He goes, oh, wait, I do have a PayPal account. And then he found his username and password. And then I sent it from my PayPal account to his PayPal account. All of that happened. And then to his bank account. All that happened in about 4 minutes. It was amazing to see how far and how quickly we've come with this. It was a seamless transaction.
I mean, next target is between 73 and 81,000. So Bitcoin is bullish. We're gonna stay monitoring that. There is no any of this kind of doom and gloom in cryptos that some of the kind of against crypto guys are telling and announcing. So I think Bitcoin it's gonna hit this 150, 70K in the next few years that you predicted. So it looks like more and more.
And I just look at gold. I just feel bad for I don't feel bad, but just what do you want to hold? Do you want to hold Bitcoin or do you want to hold gold? I mean, both are
Bitcoin,
kind of useless, useless instruments. But I think, I mean, you look basically, and I think the argument for gold, Alex, and this is a macro discussion, gold and bonds have a very tight correlation. So gold is the deflationary hedge, as are bonds, but at least bonds pay something. I think the argument for gold is getting very hard, and I think that the jewelry concept is getting tiresome. I think I'd love to know at some point, we probably could research this, what percent of total demand goes into jewelry versus investment and holding. I don't know, but I think it certainly think it's the future. Yeah.
As we talked last time, I really think that the gold is a kind of an old thing view of the people which are kind of a tide of the long history of gold as a gold. So I think in this tech era, as we talked about, people will shift more to cryptos and Bitcoin. And I think that Bitcoin definitely for several reasons cannot become currency. Money markets, lending to corporates, so that's all far away. But I will say if we see more stimulus, and more stimulus is going to come, especially if we go into infrastructure, all of this stuff, for the next couple of years, Bitcoin will be a store of value, which will go and outperform gold. That's for sure.
Got it. And there's a viewer asking real quick without going to charts. This is probably the longest show we've ever done. The next 3 months, are you bullish or bearish on the dollar?
I'm looking for a corrective pullback up in dollar. I think I'm going to be bullish dollar.
Okay, got it. And that again, everyone talking about the imminent inflation. We've been listening to that for a decade, ever since QE1, and everyone's talking about the collapse of the dollar. Dollar looks absolutely fine here. So just look at the charts, and be sure to see the trends that are actually existing rather than just kind of consuming the sensationalistic headlines that they're trying to just capture your eyes. So guys, if you're here throughout the show, appreciate it very much. Hopefully you enjoyed it. If you don't mind, just tickle that little thumbs up button or smash it, either one. Let Google, which, by the way, that Google chart has showed unbelievable relative strength. And I find very few people talking about it in this correction. Google just, holy bananas, is just held up there. So Google owns YouTube. YouTube needs to know that you love this trade analysis team. Click that little thumbs up button. And members webinar starts in 15 minutes, coffee pee break. We'll see members in 15 at tradinganalysis.com. Money management is forthcoming as soon as I get through this. Beautiful book, and all is well. So thanks, guys. Terry, Alex, Bennett, great job. Viewers, thank you for hanging out with us here on Wednesday morning. We'll see you guys soon.
Sounds good.
Right.
Take care.
See
you guys next week.
Hi, if you don't know me, I'm Todd Gordon. I worked in the trading markets as a profession and a passion immediately following college 19 years ago. As I've grown older, my trading and investment style has changed. As I've grown as a trader, my holding period for my investments was also growing longer. I was learning firsthand that being properly allocated in the right stocks and sectors on a longer term time frame with proper hedges in place and the idea of compounded returns are the keys to building real long-term wealth for most of the investing community. You can short-term and swing trade the stock and options market if you like, but do so with a very small percent of your capital. And by no means should you be trading with a majority of your investable assets or your portfolio. For our clients at Trading Analysis, we recommend that you don't trade with any more than 20% of your portfolio in the strategies for our members at tradinganalysis.com. The rest should be managed by a professional financial planner. So last year I ventured out to make a final evolution of my career in the markets. I left the very capable team at Trading Analysis that I built to run the day-to-day operations. I set out to build a wealth management business leveraging our reputation from CNBC and our years in the financial markets. We'll be launching soon, so please keep an eye out for details. If you'd like to be updated as information becomes available, please visit www.tradinganalysis.com/investments. Again, thanks very much for your interest. Look forward to what the future holds. Cheers, and let's get back to the live stream.